So a borrower came to me with a $100,000 deposit on the line. They went to their traditional bank and they couldn't fund the deal in time. Their permanent financing, which is what they would normally get, took 30 to 45 days to close, and they were buying a property where the seller was demanding a 2-week close. Here was a borrower that was financially qualified. They had the track record, they had the credit, they had everything you would want in a borrower, except all of their financing sources were perm financing sources. They didn't have a lender that could close in time until they came to me. And how could I get it done? I got it done in our bridge loan program. And in this video, I'm going to explain what a weapon a bridge loan program can be for opportunistic real estate investors. I say it a lot, but time kills all deals. And a lot of the times you can go to a bank with the best terms, find the lowest possible rate, the lowest origination fee, you name it. But then you start going through their process and you get through the first delay and then you find another delay. And before you know it, you're sitting on the edge of your seat, hoping that the bank with the greatest terms can even get the deal done. And you're on the verge of losing all that potential profit in the process. That's a great deal that suddenly went bad for no reason other than you're dealing with the wrong lender. So first, let's define what is a bridge loan. And a bridge loan is simply a loan that's going to bridge the gap between, say, a purchase and a sale, like a fix and flip, or maybe a purchase and a refi, as in the BRRRR strategy. These loans are short-term in nature, typically 12 to 36 months. They offer many different features like construction escrows, interest escrows, and other bells and whistles that match what these bridge loan programs are for, which are for speed and to usually execute, some sort of a value add strategy. So one real life example of a project I have in mind that was a perfect fit for a bridge loan was one up in New Hampshire. It was a multifamily that was clearly being operated by an absentee owner. The building was completely occupied, but the rents were way below market. It needed work. The project was off market. The borrower that was coming to me, my investor, got wind of the deal and needed to move quickly. Wanted to keep it off market. So they come to me, right? And the way that I look at this, obviously, is that I see the opportunity just like the borrower does. I see what the current market rents are and what the landlord is charging. I see what little work is needed to get the property into shape where it can be rented. And I'm able to not just look at today's value on an LTV basis, loan to value. I'm looking at the after repair value of that particular project. So when we come in to lend, we're coming in with glasses on, and through the lens, we're looking at it as a transitional play. We're saying, great, what you paid for it is what it's worth. We see the value, we understand the upside. What's it going to be when you're done? And that ultimately is what we're going to underwrite to support our high leverage going in. So on projects, as an example, in this case, it was a 5+ unit up in New Hampshire. We're able to go in, fund 80% of the purchase, 100% of construction, let the borrower execute simply turning units to market rents where the unit could vacate and we could provide the renovation money for them to renovate and release, or they could just completely turn it and with the existing owner. And that's what the borrower did. The borrower went through the project very quickly, was able to turn all of the units, achieve now the maximum value for the property. Property is now at maximum rents, hitting market rents, it's fully occupied. And at that point, they're going to the traditional lender, the bank, or a program like our DSCR loan program for lower interest rate, permanent financing, amortization, 30-year fixed rates, and looking to put on the appropriate leverage for the property and then put it to bed. Bridge loan allows the borrower to spend 6 to 12 months getting the property stabilized, using our money to fund the renovation, and then getting it to the point where it's absolutely at its maximum value, and then you're putting financing on it. Hopefully you're taking a little bit of cash off the table through the appreciation of value and the cash out refi, and then now you're deploying that cash into other projects, continue to invest and to build your portfolio. So it's just one example that I like to talk about as a situation that the BRRRR strategy just fits perfectly. So when should you as an investor use a bridge loan? And to me, bridge loans are perfect for repositioning plays, again, value add plays, and they're great for fast moving closings. I mean, quite honestly, just simply facilitating a closing might be enough to justify bringing in a bridge loan versus going to, a longer closing situation like a permanent lender, bank, or what have you, right? We're closing in 2 weeks. They might be 60 days. That might be enough to just straight lose the deal for you, right? So that might be enough. Properties that need work, definitely a great fit for a bridge loan. New construction, bridge loan. You're looking to build a house and sell it. We do that all day long. It's a great fit. Anything construction is really a good fit for a bridge loan. And then just like, timing mismatches, I do see situations where you could, as a builder, need time to get a property permitted before you can get a construction loan. So you might need to go bridge to bridge, a land and acquisition loan, land and horizontal infrastructure loan, and then it's, then a construction loan. Or it might be in the case of a condo conversion or, another project where you need permitting or what have you, might have to go in and get a bridge loan to get through the entitlement and then go to a bridge loan for construction before you can sell out. That's another example. So, bridge loans aren't meant to last forever. They're meant to execute a strategy. I think there are times where you would definitely want to avoid a bridge loan, and that would be simply taking a bridge loan as a placeholder when you wouldn't need it, simply incurring costs for a second loan closing when, you could just go right into a permanent financing would be an example, right? There are folks that come to me where the property is really in good shape. They're getting it at a really good price, and there's upside in the value if, they do this here and there, and maybe just own it for a period of time, quite honestly. But, they're coming to me and I'm saying, listen, if you're really planning to hold and you can avoid closing my loan just to get through a quick close, if you can really squeeze your contract into permanent, as an example, DSCR lender's box or a bank's box, then avoid the bridge loan if you can, and then just close it one time. You obviously don't want to incur multiple closing costs if you can avoid it. Or quite honestly, another really good example of a loan, a bridge loan that you wouldn't want to close is one that doesn't give you the amount of time you need to execute the strategy. I can't tell you how many situations I see investors when they're first getting out into the market looking for lenders. There are all sorts of different types of hard money lenders. Some may only have 6-month terms, but if you're going into a renovation that's going to take you 7 months and you're a 6-month loan, that lender is going to look for extension fees. It's going to cost you more to do that loan ultimately in the end than you're expecting, and that may not be the best bridge loan for you. There are examples right there that where the bridge loan doesn't work, and I'm sure there are others that are missing, but those are general. It's the general gist of what bridge loans are really good at and good for, and what they're not. But the reality is, with regards to interest rates, is you're only looking for this money for a short period of time. So when you look at a fix and flip as an easy example, and you say to yourself, I'm going to use this money for 6 months, and I'm going to renovate it for 4 months, the property, I'm going to put it on the market and sell it, and that's going to take 2 months to sell. I'm going to have your loan out for 6 months max. You don't care about how low the interest rate is in this situation. Why? Because you were able to close the loan in 2 weeks and get yourself into a position where you could acquire the property fast and get the money to renovate the property and be able to turn around and sell it within the market and be able to do that within a certain time frame. When you equate it to the interest rate, let's say that borrower was paying 12% interest rate. Well, he was paying 1% a month on the money you borrowed for 6 months. So that's 6% in interest in total for our money. Now, you could look at it that way. You could look at it as our opportunity cost. You could look at it like we're coming in at a higher leverage level, which means you have to bring less of your own cash to closing, and that cash maybe could go and be deployed in other properties and earn a higher return. So you're able to, spread your money out, invest in more properties. And there's a lot that goes to it with the types of lending we do. Oftentimes, again, we're higher leverage. We're offering 100% of construction on top of funding up to 90% of the purchase of the property. So there are trade-offs for sure as to why borrowers with perfect credit, folks with 20 million in loans repaid with me, that come back to me and still opt to pay rates of, say, 8.99% and 1 point, even though it's higher than the bank, because we're closing fast. We have the certainty of execution. We fund construction draws faster than the bank could ever fund. And we get the borrower through the process and onto the market or into a place to refi fast. And speed is money. And we're able to gobble together this, let's call it, pool of equity and deploy it out there to really good borrowers who know how to use this money and use it well, perfect credit or not. They see it as an opportunity and they look at us as a partner, and we come in and we routinely close in days, and the interest cost in the end are a byproduct of the deal and the opportunity, and it's all underwritten within the context of the deal itself. And so at the end of the day, interest rates, certainly something to pay attention to, but don't go out there and try an unproven lender because you're saving a half a point on interest, because I can almost assure you it's going to come back to bite you in the end. So one of the best things about my business, hard money, residential transition loans, bridge loans in general, is that I get to look at the borrower's experience and not have to worry about what income they make per year, worry about their tax returns, what their employment status is, what their debt to income ratios are. None of that. We look at experience. Simply put, we want to count how many deals that you've done, call it, within the strategy that you're coming to us for. So if you're looking to build a new house with us, we love new construction. We're going to count how many projects you've constructed or houses you've built on spec and sold within the last 3 years, or houses that you have built on permit for a third party. And we're going to count those up, and we're going to figure out how much experience you have in the last 3 years, and then we're going to reward that experience with higher leverage and lower rate. So the more experience you have, the lower risk we feel we have, the more we're going to lend to you in terms of leverage, and the better rates you're going to get from us. We're going to always look to the borrower's experience in our business. We want to make sure that the borrower can execute the strategy right. The risk is in execution of the renovation in a fix and flip, or bringing the rents to market, maybe in a multifamily BRRRR strategy. We want to make sure that the borrower's experience matches the property's profile, the property strategy that they're coming to us to fund, and then we're going to reward that. We're going to count it up, reward that, and it's going to be a very simple process. On the first deal, we're going to have you fill out an experience worksheet that lists these properties, and then in processing, we're going to verify through, making sure that you are an owner on the LLC that was on title for that property, or, by asking for permits to verify. Once you're on board with a company like asset-based lending, it's easy from there on out. It's really just rinse and repeat, and deal number 2 and so on and so forth becomes so easy because we know you, we know your experience. And again, as you do more and more, we're going to reward that experience and drop rate and increase leverage. If you've been sitting on the sidelines because you worried that your bank or your lending institution can't close in time, you got to call me, message me, comment. Make sure you get in touch with me, because bridge loans are perfect for transitional plays. And a lot of folks shy away from the properties that are the best opportunities, the ones with the most profit upside, simply because their lender won't allow them to be able to even play and buy it to begin with. That's why we're here. We're bridge loan lenders. We're in the speed of money business, right? We understand the strategy, and we're going to be there to approve loans in 24 hours and close in 2 weeks. And it doesn't really get much faster than that, folks. So DM me, don't be shy. I'm here. I'd love to connect with you, see if I can't win your business. We have great programs here at Asset-Based Lending, and we're funding a lot of construction, both renovation and the fix and flip and new construction. So reach out. Thanks for watching, and please, like if you like the content, and subscribe for more. I'm going to be putting out a lot of videos, and I'm just going to keep the content coming. So I appreciate it, guys. Thanks for watching.